Have you ever wondered why some people say all debt is evil while others say debt can be the tool for success? Today we are going to clear up the confusion around good debt versus bad debt. This is one of the most important concepts to master for your financial future. Let us start by defining what debt actually is. Debt is simply using someone else's money to pay for something now, with a promise that you will pay it back later, usually with a little extra called interest. In the first section, let us define what makes debt good. Good debt is essentially money you borrow to pay for things that increase in value or help you generate more income over time. Think of it as an investment in yourself or your future net worth. A classic example is a student loan used to get a degree that significantly boosts your earning potential. If you borrow money for an education that allows you to get a job paying $50,000 more per year, that debt helped you create long-term wealth. Another example is a mortgage on a home. While not guaranteed, real estate often appreciates in value over time, and you get the benefit of living in the house while you pay it off. The key here is the return on investment. If the asset you are buying creates value greater than the cost of the interest you are paying, it leans toward good debt. Now, let us move to the second section, which covers bad debt. Bad debt is money borrowed to purchase things that lose value quickly or do not generate income. These are often consumer goods that depreciate the moment you buy them. The biggest culprit here is high-interest credit card debt used to buy things like clothes, gadgets, or vacations. When you put a fancy new phone on a credit card and pay it off over 2 years with 20% interest, you are actually paying far more than the original price of the phone. Because the phone is losing value every day, you are essentially paying extra for something that is worth less and less. Bad debt traps you in a cycle of paying for things you no longer even enjoy. It eats away at your monthly income through interest payments instead of allowing you to save or invest that money for your future. The third section is about the cost of borrowing. It is important to remember that even good debt can become bad if it is too expensive. If you take out a student loan with a crazy high interest rate, or if you buy a house that you simply cannot afford, even the most productive type of debt becomes a financial burden. This is where the concept of affordability comes in. Just because a bank is willing to lend you money does not mean you should take it. You have to look at the interest rate and your own cash flow. Can you comfortably make the payments every single month without sacrificing your emergency fund or your ability to save? If the answer is no, then that debt is bad for your specific situation, regardless of what you are buying. Section 4 involves red flags to watch out for. How do you know if you are sinking into dangerous territory? A major sign is when you use debt to pay for daily living expenses like groceries or utility bills. If your income does not cover your basic survival needs and you are relying on credit cards to bridge the gap, that is a huge red flag. Another sign is when you are only paying the minimum payment on your loans. This means the interest is piling up and the principal balance is barely moving. If you find yourself in this situation, it is time to stop taking on new debt immediately and create a plan to pay off the high-interest items first. In summary, the main difference between good and bad debt comes down to whether the borrowed money is helping you grow wealth or shrinking your wallet. Good debt focuses on assets that grow or improve your income, while bad debt is usually linked to consumption that loses value. Take control by being intentional about every loan you sign up for. Avoid using credit for things that depreciate, and always calculate the true cost of interest before you borrow. Follow Beeps Finance for more simple money explanations.